Hey everyone, this is Kirk here again at Option Alpha. So tomorrow is Fed Day. That means that the FOMC is releasing their interest rate decision tomorrow. It's going to be a big market event, of course, because it's the first time we're getting into a rate cutting cycle, which they've already signaled they're going to cut rates, highly anticipate that they're going to cut rates. It's just by how much are they going to cut rates, and more importantly, what is going to be the market's reaction to these rate cuts. So I was a little bit inquisitive on this because generally speaking, during Fed events, I don't not trade. It's not like I don't trade Fed events. I just let my bots trade through Fed events. But since I've been trading more zero DTE strategies, I've been trying to figure out what can I do on Fed Day. And I feel like sometimes where people are ignoring opportunities, maybe there's an opportunity. So I ran some numbers and some stats on prior Fed days just to see what the market generally does on Fed days, to see if there's anything that could be a tradable event heading up to the Fed Day, the actual Fed Day itself, or after the Fed Day, the FOMC meeting itself. So I published that research on the website so you can get access to it. I'll put a link here if you're not already on the blog actually watching it. It'll be right below in the video notes. And I wanted to go over some of the things that I found and then also just talk through my strategy that I'll be deploying tomorrow. It's kind of a two-part strategy. One is a zero DTE strategy for the actual Fed Day itself. And then another one is going to be a next day zero DT strategy. So one day we're going to trade the next expiration and get into a position at the end of the day tomorrow on Fed Day, hopefully if we can get filled on it. But I'll go live tomorrow and be doing that. So just be on the lookout for that if you want to subscribe. That way you get notified when I go live. It'll be probably sometime in the afternoon. Okay, so first things first. The first thing that we did when we ran our research was we just looked at prior Fed days in a silo by themselves versus non-Fed days. And what we were trying to figure out at first when I was going through this was, is the Fed day more volatile than non-Fed days? So all other non-Fed days compared to Fed days, if we just bracketed those Fed days in their own little grouping, then are they more volatile? Now, of course, we have to take this with a little bit of grain of salt because Fed days don't happen every single week, right? There's not that many of them per year, but we try to bunch together many years of Fed data just to get an idea of, like, generally speaking, are Fed days more volatile? And so this is the first graph that we put in the research, which was that, yeah, on average, the daily price move of the market, the S&P on Fed days, was significantly higher than non-Fed days. You can see the average move on a Fed day was about 2%, and the average move on a non-Fed day was about 1.25%. So still a pretty big move on Fed days. That kind of reconfirms a lot of suspicions that traders have, which is generally that Fed days are very volatile. So we know that. We can kind of feel that instinctively. If you've ever traded through a Fed day, you know Fed days are crazy and the markets are all over the place. And so now we kind of put that one to rest. We know they're more volatile, but we don't know yet what we can possibly do trading. So the next thing we looked at is the SPX price range on Fed Day itself. And this one was very interesting for me because what I wanted to get a sense of, and I didn't actually know, was did we have these Fed days where the market was down and then it had a huge reversal back the other direction? Or, did it open high and trade low and then go back the other direction and close really high? And what you'll notice with this, and we kind of charted this as a candlestick chart because it just makes the most sense, where you see the high and the low, and then you see any of these wicks. So any of these black wicks on these candlesticks, those would be like the intraday high or the intraday low. And if the day is green, the market was up. If the day is red, the market's down. I'm pretty sure you guys know how candlestick charts work. But what was interesting to me about this one was that we didn't see a lot of wicks. In fact, the only one that we saw right here was 3 meetings ago, basically, where we saw this big intraday reversal where the market was up and then it actually reversed and closed at the lower end of the range. But generally speaking, we see full bars for Fed days. And what that means is that the market opens and usually rallies and continues in that same direction, or market opens and goes down and then continues in that same direction. So it will be interesting tomorrow to see where the market actually opens and what it does kind of in the first half of the day, maybe even heading into the Fed event. Because if history is any judge of that, it likely means that the market might continue in that direction through the Fed event, or at least not go back the opposite direction and reverse. So again, we didn't have too many days where we had these really big reversals, probably just literally one in this whole entire sequence that we tested going back a couple years. Okay, so the next thing that we looked at is we looked at the S&P percentage moves on positive days versus negative FOMC days. This is not regard to interest rates, it's just regard to closing. So if the market closed up or closed positive on an FOMC day, what was the makeup? What was like the characteristics of that FOMC day? And so we kind of broke it out into a couple different regimes of different percentages. So if the market closed up on an FOMC day, what percentage of the time did it close up, quarter of a percent to half a percent? What percentage of the time was it, 50 basis points, like 0.5% to 1%? What percentage of the time did it close higher than 1%? And then we did the same thing for negative FOMC days. So this is if the market closed down on an FOMC day, what was the breakup of what the percentages were? And you can see it was almost a significant, or much more of the time when the market was closing down, it was closing down by more than 1%. And the key takeaway for me is that if the market was up on an FOMC day, it was likely up less than 1% more of the time, right? So if it was up more than 1%, about 41% of the time, then the opposite would be true, that the market was going to be up, but not up more than 1% a significant amount of the time, or a majority of the time. So that was pretty telling. And if the market was down on an FOMC day, you could pretty much bet that the market would be down more than 1%. 66.7% of the time the market was down more than 1% on FOMC day. So it's going to have a pretty big drop if it does. Okay, next thing that we looked at, and this is where things I think to me started to get very interesting, because I still wasn't finding, as I was doing this, I was like, there's not really anything here. And if there wasn't anything here, I don't have to do anything, right? But the other thing that we looked at is we looked at the average daily percentage move heading into a Fed event, both 5 days before and then heading out of a Fed event 5 days after. And then we also looked at 1 day before and 1 day after. So if you look at the right-hand side first, actually, this is 5 days before the FOMC meeting. So what did the market basically do in those 5 days before the FOMC meeting compared to all other days? So the dark blue box here, that's all other days. So all other non-FOMC days. And you can see if we just look at the 5 days before the FOMC meeting, the average range of the S&P, those 5 days before was about the same as all other days. So it wasn't like the market had these huge moves heading into the Fed. It was actually that the markets generally were about what they were heading into the actual Fed event. When you get to the 5 days after the Fed event, that's when you saw a lot more movement. And so this is not just the 1 day, which we'll come to in a second. This is the 5 days after the Fed announces. The average range in the market was a little bit wider. And so maybe this is more that traders are positioning themselves, and portfolios and institutions are positioning themselves after the actual Fed event. And then you start to see that repositioning take shape over a couple days. So that was pretty interesting at 5 days. Then we moved it down to 1 day. This is where I think you get a really interesting look at, kind of what happens here. But again, the day before the FOMC meeting, which is basically today, the day that we're doing this video, is about the same volatility as all other days, give or take. Maybe a little bit more volatile heading into it, but about the same. It's the day after the Fed event that we saw a significant spike in volatility. This is, again, just like showing that basically traders, institutions, people are repositioning themselves a lot more after the actual Fed event itself. And that was really telling. So the next day is actually potentially more important, or maybe it's going to be a more volatile day than the actual Fed day itself. All right, so then we looked at this one, and this one was a really interesting one to me. This one kind of laid the groundwork for a potential trade that I think I want to get into tomorrow. And this is the S&P price move the day after, the day before, and the day, after the FOMC meeting. So the day before the FOMC meeting, this pie chart on the left, you basically had a coin flip of the market being up or down the day before the FOMC meeting. So it wasn't anything that you could easily trade into, no discernible edge here. If you tried to buy into the FOMC meeting or sell into the FOMC meeting, it was pretty much a coin flip, very, very close. The day afterwards, however, was significantly tilted in favor of bearish trades. And so it looks like the day after the FOMC meeting, 66.7% of the time the market was down the following day after the FOMC meeting. And again, we know there's going to be a lot of volatility from the last chart. So it's pretty telling that maybe the better trade, maybe the discernible edge here might be the day after the actual FOMC meeting itself, okay? So there's two things that we can do here. The first thing that I think we can do is we can potentially trade something around the negative movement of the day, and potentially that if the markets are going down tomorrow, we could trade that negative move. If the markets are going up tomorrow with a 0DT strategy, we can try to look for something that's maybe selling a call spread that's more than 1% out of the money. The goal here is that if we sell it more than 1% out of the money on FOMC day itself, there's a little bit of an edge that we've baked in here that the market doesn't generally move up more than 1% when you have those positive FOMC days. So that's kind of the 0DT strategy that we could have for tomorrow itself. So if you go into the 0DT Oracle, what I'll be doing tomorrow, and I'll jump on live and kind of do this and go through this, but my thought process is to look for trades that are, again, 0 days. So you go into 0 days, potentially look at something like a short call spread, and then start filtering here for positions that are 1% or more out of the money. Now, right now, there's not any trades because volatility is super low. Tomorrow, and if we could even just look at the next day trades here, which is, again, going to be Fed day, you can see there's lots more volatility in pricing because everything has kind of already moved to tomorrow's expiration. So assume tomorrow is going to be zero, the 0 day contracts, but right now they're the next day contracts. But this is what we'd be looking for. We'd be looking for trades that are at least 1% out of the money. Ideally, if we can get into this right before the Fed announcement, then we give ourselves an even bigger buffer of margin. I think that the announcement itself will almost kind of be like an earnings event where we get a volatility crush that happens after it very quickly, but heading into it, volatility stays high. Nobody knows what's going to happen. Things are kind of crazy, but that might be the potential opportunity here. And then again, it would be coming back to this one at the end of the day, truly looking at the next day and saying, okay, how can we get into a position for the following day? Because we know that 66.7% of the time, the day after the FOMC announcement, the markets are down. So can we make a trade based on that? So we'll be looking to make a trade in addition to the day trade, into the 0DT trade, a day the next day of the FOMC meeting, and try to get into a bearish position there. So I hope this really helps out. I hope going through this research helps you kind of figure out if you see any potential trading strategies in there. I know for me, I like this. I'm going to try to take a shot at it and keep doing this on a reoccurring basis for FOMC meetings, because we have these are now tradable events. To me, I don't want to skip them. I want to try to take advantage of some opportunity. As always, I'll keep my position sizes super small, but I'll jump back on tomorrow and see if we can find any good trades heading into the Fed. So if you guys need anything, let me know. Until next time, happy trading.